Well, I mean, there's so many aspects of this, but so I'll try and boil it down to a few simple points. One point is that there was no speculative interest in COMEX or indeed in London ahead of this. What subsequently transpired was there was speculative interest on the Shanghai Futures Exchange, and quite a lot of that on the short tack. Not long. I mean, this guy was Bain something or other, Xiling or something, short of over 30,000 contracts. And what's interesting is that next week is Chinese New Year, Year of the Horse. Markets are shut. Mr. Bain has been told you cannot sell anymore. So the only thing you can do is buy to close. Or deliver. I'm awaiting the squeeze. I think the squeeze could be quite dramatic at the Chinese end. Anyway, so we'll see what happens there. But the other point I'd like to make is that on this dip, I'm hearing from everywhere around the world that buyers for gold and silver were just queuing up to pick it up deep levels. Now that's interesting because it tells us that the psychology behind the market now is immensely positive. People are beginning to understand why you should have gold and silver. And the people who are understanding are central banks, governments, let's say some of the super rich, wealthy Asian families. They're not all. The people who may be people with huge great funds who are close to government and know what central bankers are thinking. And perhaps some old money, which understands the difference between money and credit, not that many people do, but understand that it's credit going down in value rather than money going up. Because, I mean, that's the point. It's not a bull market for gold, it's a bear market for fiat currencies. So there's that. The other point I'd like to make is that the geopolitics are evolving really very rapidly. I mean, interestingly, China has always taken the view, why interfere with the dollar's demise when the Americans are basically making all the mistakes? So really, for the last, 3-4 decades, they've just sat back and let America make all the mistakes. Every time America comes out with something against China, whatever, it ends up, China doesn't get hurt, really. And the dollar gets undermined. People start losing confidence in the dollar. I mean, a good example was cutting Russia out of SWIFT and stealing Russia's central bank reserves. So literally everything they have done has just backfired on them. And so the Chinese have done nothing until last September. Last September, they finally decided that it was time for them to act. You have a capricious president in President Trump. You can't trust a word he deals with. He changes his mind every minute. He's, 1 minute he's peacemonger wanting the Nobel Prize, another he's all for bombing the hell out of someone or other. I mean, this is unstable, if you like. And it really started with the Chinese saying, okay, rare earths, you're not having them. And literally just stopping the export of rare earths without an import, an exporter and a foreign country having a very, very good reason to do so and being relatively friendly to the Chinese. I think what's really, if you join the dots though, it was about the same time that things changed for silver, because until then, China had been happily supplying silver into the market, basically to suppress the price. But then they turned around and, America suddenly decided, this is a critical mineral. So China's attitude towards silver changed at that moment quite sharply. And I think various other things too. So what we saw was suddenly there was a liquidity squeeze in London where I think it was October the 9th, you'll correct me if I'm wrong, lease rates shot up to nearly 40%.
Yeah.
Backwardations between London and COMEX appeared for a while. We've had consistently, you would think that this is just a problem confined to us in the West, but no. I mean, actually, the price of silver on the Shanghai Gold Exchange and also the Shanghai Futures Exchange has been higher by significant premiums over ours. So, I think this sort of tells us two things. First of all, the price is actually made in China, not here, which is very, very important. I think the second thing about it is that, the supply situation in the West is still dire. And actually what's happening, if you get to the bottom of it, what's happening is that people are getting out of paper into physical. And I mean, when you've got, say, 100 times paper as you have physical or no physical, I mean, where do you go? And this is why you've got problems in the market. And they've only just begun, in my view. I think it's going to continue because unless the Chinese relent, and I don't think they are, bear in mind that they're now on the warpath. They turned around and told their own institutions yesterday or day before, don't buy US treasuries. Reduce your positions. Get out of crypto. We're banning it completely. Anyone who deals in crypto is going to jail, sort of thing. So they're clearing next, in my view. This is classic, absolute classic. So we're into a financial war, and the beneficiaries of this are going to be commodities as a whole, led by gold and silver. And I think that broadly is roughly where we are, Andy.
Oh, that's really well put, and I think very succinct. And I think the PBOC. My understanding is the PBOC was very, very, very unhappy with this trader that we talked about a little while ago. Really unhappy because what China's been doing is creating the SGE is physically backed. So if I want to trade, buy or sell a bar on the SGE, I have to own that bar. And so essentially what they created is this very, very stable, as you say, the price really didn't come down a lot based on this huge drawdown. And if one looked at that and then you see, my understanding is, and I won't use the words that they told me, but they were very unhappy with what happened. And so what this 450 tons, and what there was only 300 tons of supply. So obviously that created a problem, and it sort of pushed back against. So I understand that this trader had other trades had written options positions on the COMEX.
There are so many moving parts in what we are witnessing that one has to be careful not to get lost in the noise. The temptation in markets, particularly in precious metals, is to focus on the daily volatility. But if you step back and look at what preceded that volatility, the picture becomes considerably clearer. First, there was no meaningful speculative interest in COMEX or in London ahead of this most recent move. That is a critical point. The rally did not begin as a Western paper squeeze driven by hedge funds piling in on the long side. Quite the contrary. What we saw initially was speculative interest on the Shanghai Futures Exchange. And interestingly, much of it was on the short side. There was one particular trader, we need not obsess over the name, who was reportedly short a very large position, tens of thousands of contracts. That is not trivial in a market that is increasingly sensitive to physical tightness. Now, layer on the timing. Chinese New Year. Markets closing. The trader in question being told, in effect, you cannot add to this position. You may only close it or deliver. That creates a very interesting setup, because if one is heavily short into a tightening physical market and is suddenly prevented from expanding that short exposure, the only exits are to buy back contracts or to deliver physical metal. And if the physical metal is scarce, which it is, you have the makings of a squeeze. I am watching that Chinese end of the market very closely. The squeeze, if it unfolds, may not be gradual. It may be rather dramatic, but that is only one aspect. The more important development, in my view, is the psychology shift. On the dip, and dips have been sharp, buyers were reportedly queuing up across Asia, the Middle East, and even parts of Europe to accumulate gold and silver at lower levels. That tells you something profound. It tells you that the underlying demand is not speculative froth. It is strategic. Who are these buyers? Central banks, governments, wealthy Asian families with generational memory. Old money. People who understand the distinction between money and credit. That distinction is absolutely fundamental. Gold is not going up because it is fashionable. Gold is not in a bull market in the conventional sense. What we are witnessing is a bear market in fiat currencies. Credit is losing purchasing power. Gold is merely holding its own. Most people misunderstand this because they have grown up in a purely credit-based monetary system. They assume that dollars, euros, pounds, these are money. They are not. They are credit instruments backed by government promises. Gold is money. It is no one's liability. And as government debt levels spiral, not just in the United States, but across the developed world. The realization is slowly dawning that credit is not a stable, long-term store of value. Now let us turn to geopolitics, because one cannot separate markets from geopolitics any longer. The shift has been subtle but decisive. For decades, China's strategy towards the dollar has been remarkably patient. The Americans, if I may put it bluntly, have been undermining their own currency through fiscal indiscipline, sanctions policy, and weaponization of the financial system. China did not need to interfere. Why interrupt your opponent while he is making mistakes? The freezing of Russian central bank reserves and the exclusion of Russia from SWIFT were watershed moments. They sent a signal to every sovereign nation. Your reserves are only safe so long as Washington approves of your foreign policy. That realization cannot be undone. Since then, de-dollarization has accelerated quietly but persistently. China has been increasing its gold reserves. So have numerous other central banks. The World Gold Council has documented record central bank purchases in recent years. That is not anecdotal, it is empirical. Then, last September, something changed more visibly. China began asserting itself in strategic commodities. Rare earth export controls were tightened. Licensing requirements increased. This was not theatrical, it was strategic. And around that same period, we began seeing changes in the silver market. For years, China had been a supplier of refined silver into Western markets. The flow helped maintain liquidity and arguably suppressed prices relative to true physical demand. But when the United States designated silver as a critical mineral, the strategic calculus shifted. Suddenly, silver was no longer merely an industrial metal in the Chinese policy framework. It became an asset with geopolitical implications. Then came the liquidity squeeze in London, lease rates spiking, backwardation appearing between London and COMEX. That is not normal in a well-supplied market. That is the symptom of physical stress. Meanwhile, Shanghai silver prices were consistently trading at premiums to Western benchmarks. That is extraordinarily important. For decades, price discovery was assumed to occur in London and New York, paper markets. But when the Shanghai Gold Exchange operates on a physically backed basis, meaning you must own the metal to sell it, and prices there remain elevated relative to Western paper markets, you must ask, where is true price discovery happening? The answer may no longer be London. Now consider the structure. In Western markets, paper claims on gold and silver vastly exceed the available physical metal. The leverage is extreme. That system functions so long as most participants roll contracts rather than demand delivery. But if participants begin migrating from paper claims into physical ownership, the leverage becomes a vulnerability. We are seeing early signs of that migration. The Chinese authorities were reportedly unhappy with the large speculative short position we discussed earlier. Why? Because they are building the Shanghai Gold Exchange as a credible physical price discovery mechanism. Excessive paper speculation undermines that stability. When physical supply on the exchange is, say, 300 tons, and speculative positioning represents 450 tons equivalent, you create distortions. That cannot be allowed in a system intended to demonstrate integrity. So the speculation was curbed. Now step back further. China has reportedly advised institutions to reduce US Treasury exposure. Crypto trading has been restricted aggressively. Capital controls are tightening. If you connect the dots, this looks very much like financial war positioning. And in financial war, commodities, particularly monetary metals, become strategic. Gold and silver are neutral settlement assets. They carry no counterparty risk. They are accepted globally. When trust in sovereign credit erodes, whether due to debt burdens, sanctions policy, or geopolitical fragmentation, gold's role strengthens, and silver, as the historically co-monetary metal, follows.